Hello, I'll be going over PD arrays today in today's video and how you can use them. Um, for our first two, we're actually going to go from simplest to most difficult. And for our first one, it's going to be a fair value gap. Fair value gap is basically, it's pretty simple. It's a three candle formation, and it is, if I can get my drawing tool up here. This would be the three candle formation right there. That little circle, the candles in that circle. Why? Because we leave a gap in the middle. Um, so what makes this, it's basically an imbalance. When price taps back into it, it's going to push higher. Like we can see right here, if you entered on the tap of that fair value gap, targeting for that, you would have caught a 1 to 3 pretty easily. Like that. But obviously these are not the strongest P array. Like you shouldn't be taking trades off them just by itself, and you should be using other confluences as well. But that's it. I know it can be a little confusing at the beginning. Just know it's a three candles formation, and the candles, it needs to have a gap. That's why it's called a fair value gap, because we have this little gap right here. As for, see that little gap, that makes it a fair value gap. It don't care about the end, well, for the direction of a fair value gap, don't worry about the first or third candle, worry about the second candle and what color it is. If it's green, well, it's not on this chart because I have different colors, but on a normal chart it would be green. It would be a bullish candle, a bullish fair value gap, so price would push higher. If it was a red one, price would push lower. And for this example, it's a green one, so you see price taps into it, price pushes higher. And I can show you an example of not a fair value gap, because what is it called? I can definitely find one pretty easily, but let's see. Oh, here. So, three candle formation. This down candle, up candle. Why wouldn't this be a fair value gap? Well, because there is no gap in the middle right here. And we see price just pushes higher, obviously, because there's nothing to push lower from. But yeah, you see that this wick is actually overlapping with this one. So that would not be a fair value gap. But the thing is, if there's a gap, it's a fair value gap. If the wicks are overlapping, it's not a fair value gap. It's as simple as that. That's honestly all it is. If you want to, take a picture of this and reference it every time you see a fair value gap, do it. They're not hard to see though, honestly. But yeah. For next one, it's gonna be a little bit easier. From knowing what fair value gap is, we see that sorry, we formed a fair value gap right here. Three candles up, three candle formation. What is an inverse fair value gap then? Well, let's just use common sense and say that an inverse fair value gap is when a fair value gap gets filled. Filling a fair value gap means, see this candle closed over the fair value gap and invalidates the idea that if price hits it, it's going to push lower. Instead, how do we use this inverse fair value gap? Well, let's look. We have price closes right here, right there. Price closes over the fair value gap, and that makes it an inverse fair value gap. Now, how would we use that? Consequent encroachment. What is consequent encroachment? The 50% line of any PD array. PD arrays are fair value gaps, order blocks, any form of, well, not any form, but like just any blocks or any gaps. That's what CE is, consequent encroachment, 50%. Now what happens? Price taps our CE right here on when the fair value gap forms. Put our stop loss on the end of that, and then you target a high. And then, what do you see? Price pushes up to our take profit. That's how a lot of people use it. You can also use it just as like price closes over it and then price just keeps pushing lower like this. Like you see that, that fair value gaps get inverse and price just keep pushing lower. It doesn't always come back to 50% it, like you go to the 50% line of that inverse fair value gap, but that's usually what it's used for, but I personally don't do that. I personally let it run for direction because that was my model back in the day, but that's how you can use an inverse fair value gap. Remember, consequent encroachment, 50% line, filling a fair value gap, closing over the end of a fair value gap to invalidate the idea that price is going to push lower from that area of imbalance. And then price will push higher after hitting the consequent encroachment or just tapping the inverse fair value gap in general. Our next one. This concept that I have, honestly, I didn't get it for a while. Like, I didn't get a great understanding of it for a while, but here's a very good example that I found. Now, what is an order block? An order block is also a very basic PD array. And what is it? The last down close candle or up close candle. Okay. For what is it called? There's a moth outside my window, but for our first one, if we have a bearish, oh my gosh, this is so bad. Oh, whatever. This is our innate uptrend, okay? What does price do? There's going to be an order block in every single one of these. And where would that order block be? Can I actually just draw this a bit better? Okay, I'm going to just draw a downtrend first then. Break it. Get rid of this stupid ugly candle. What do we see? Let's say that there are 2 candles in each one. Well, oh my gosh. Sorry guys, let me try to just draw this a bit better so you can actually understand it. Although there's a candle. There we go. So, let's say this line right here is 2 candles. We have this, then this. You can use these in almost any way, honestly. There's a bunch of types of order blocks, but I'll tell you the ones I use. For mine, I use either like this, closing, like that, like the body, just not the wicks, the body and not the wicks. Or you can use this, the line, you see the line of the open, well, the open of that candle. Now, what do order blocks do? Price will retrace 2 order blocks like we see right here. Price will retrace up into that because we see that price obviously came up to that order block that we have. And then price will push lower. But that's a bearish example of a bearish order block. Now, what is a bullish example? A bullish order block will always be a bearish candle. A bearish order block will always be a bullish candle. Write that down. Bearish order block equals bullish candle and vice versa. That means other way around. So bullish order block for a bearish candle. Now, we see that we listed this out. This is a very nice example. You could have entered on the consequent encroachment, the 50% line. Put stop loss at the end of that order block and target the previous day high for very good RR for a 1-16, and you're getting 50 points for 3 points loss. That's a very good example of an order block that I found, and I can give you guys a little bit of sauce on a better order block, but that's what you need to know. That's the main premise. So in a bullish trend, this is a bullish trend, the last bearish candle before the move up. Obviously, this is a doji. A doji is just a candle with no color. That's what it is. Those aren't really relevant. Don't trade them off patterns, but that's a doji. So this would be our last bearish candle before the move up. And what does price do when it comes back to that bearish candle? Price moves higher. That's the simple of it. And I mean, there's obviously bearish order blocks, but this is a bullish one. Basically, just if you flip the screen, the same thing would happen in a bearish scenario. But yep, that's bearish order blocks, bullish and bearish order blocks for you. And we're going to go to our next one, a breaker block. Now, what is a breaker block? A breaker block is an order block. Well, I'll tell you the easiest way that you can find one. You can use this pattern that I'll tell you right here. From this candle, what do you see? How does price move from this, no, not candle, but from this line to actually, yeah, to this line? How does price move? Zigzag, right? We see up, down, up, down. That is the pattern you need to remember for a breaker block. Now, what is a breaker block in like definition? It is a failed order block. That's why I taught you order block right there. That's why you need to remember that. What do we see? A move higher, right here. Well, actually, I should draw, but move higher, low, higher, because it's an uptrend. This is going to be a bearish order block, by the way. But then what happens when price returns to order block? It doesn't go up like that. No, it doesn't do that. What does price do? Probably should have drew it differently. Price comes up, comes down, comes up, and then goes all the way down. It runs through it. Now, in order block, remember that. You can use the bodies, but that's what I do. So, but look, you draw out the bodies of the order block, and I don't usually use breaker blocks. This is a breaker. But I'm just telling you because I know what this one is. Well, price comes up to CE, taps the consequent encroachment, and what do we target? The low that was created before that move higher. Price taps the CE, price comes up, taps it again, edges our stop loss, and then pushes to that low. That is going to be a breaker block. Pattern for a bearish one is up, see, up, down, down. Because then price will come up into here, into the breaker block. The breaker block is the order block that failed, by the way. And then price will push, let's see, up by lower. Now let's show you a bullish example with, what is it called? And then a bullish breaker block starts with a low, high, low, high. Why? Because this bearish order block failed. So what is price going to do? Price is going to come back down, tap this. It doesn't have to be consequent encroachment, just tap the order block, and then push higher. That is going to be a breaker block for you guys. If you guys have any questions, you guys can ask me, because I know breaker blocks are a bit confusing, but that's all a breaker block is. A failed order block, and price comes back to tap it. That's all it is. Now, I think that's all of the pretty good ones. I'm going to show you one more, but it's going to take a little bit more time. It's going to be at the end of the video, but here's another one. This is a rejection block. What is a rejection block? A rejection block is a candle that has a big wick, okay? Like you can see right here. But why does that have a big wick? Because it reversed off of something. But why is this just not liquidity? Why is this not external liquidity instead of a rejection block? Why? Because price came back to it very quickly, meaning price either wants to push higher or price is going to leave this zone. And a lot of the time, this is pal strategy, by the way, a lot of the time price will want to move higher. Okay. I am sorry. Oh my gosh, where's this? What do we see? Usually when trading rejection blocks, they are a bit confusing, so ask me any questions if you need it. But since we swept Asia's low of previous, well, not previous day, but of Asia's low, price will reject off of it, but then price came back lower. What did price do? Price came back into the rejection block. You could have entered off of, well, this CE or this candle right here. I know there's a precision, I'm going to guess there's a precision swing point right here, but you guys don't know what that is. Yeah, I probably won't be teaching that for a while. But let's see. What's something we can do? Oh, order block. Okay. Order block because it's the move. It's the last bearish candle before the move up. So what do? Wait for price to tap the C of that order block. What does price do? Tap the C of that order block. You could put the stop loss on here, or stop on that order block. But rejection block is the main premise of the fact why price is pushing higher. And then what you can do, put price at this high, and then wait for it to play out. And there you go. You got a 1 to 2. If you did the order block, it would be a 1 to 14. But that's because the order block is smaller on a smaller time frame, and that's kind of time frame alignment because 15-minute rejection block right here. Then on the 1 minute, you see a 1 minute order block, and then you see that you wait for it to tap CE, wait for it, and then put stop on that, and then you can get a really good risk reward. That's going to be a rejection block for you. Honestly, I'm not the best at it because I use them sometimes. They are a good tool. I only use the optimal trade entry. I know I went over that in what is it called in another video. But optimal trade entry, these zones get tapped a lot and they get a strong rejection off them too, and the consequent encroachment does as well. But yeah, that's what this is. That's what a rejection block is. Now, going into our last example, I think, nah, we don't. Okay. I'm going to try to find a 15-minute order block. So, okay, wait a minute. Sorry. Trying to find one that got tapped. I'm just going to delete all this. Just go back in the video if you need it again. Okay. This works, I guess. This would be an order block. A 15-minute order block right here. You could use the change in state of delivery or the order block. The change in state of delivery is just the open that I taught in the order block thing. That's just basically what it is. I don't have Sheens. Oh, I do, but I don't use it. So. Okay. What is this? What do we see? This is an Enigma order block. Why? Because there's imbalances. What are imbalances? Fair value gaps. Where do we see them? All the way down here to up here. You can literally even see them on the other side right here. So what can you take an entry off of? 15-minute order block, Enigma order block created because we have an imbalance in there. Okay, price inverses it. You literally have what is it called? Wait, I'm trying to see if I can. Okay, no, never mind. What do? Wait for the CE or wait for the Enigma order block to get tapped, and you see that CE gets tapped here. Actually, wait a minute. Am I? Okay, I might be off something. Sorry. Oh, sorry, yes. This is actually not a what is it called? Wait, is it? The last. Okay, it is. Okay. No, that is one. Okay. So, yeah, sorry guys. I just got a little confused right there, but put the stop on the end of that Enigma order block. What do you target? You could have targeted these highs, and you would have gotten a 1 to 3 very quickly. Right there. That is an Enigma order block, a order block with on a higher time frame, and then on the lower time frame it has imbalances in it. It's a basically a stronger version of an order block. And since I don't think I give a very clear understanding of a change in state of delivery, I will. And I'll try to find one where price actually tapped that change in state of delivery, although it did right here. So look, bearish candle before move up. What does price do? Close over that, changing the state of delivery, price delivery. Basically, just know this. I'm going to literally draw it out on this. Okay. Price has 2 down close candles. It doesn't have to be 2. It can be any amount of down close candles you want. What does price do? Close like this. Then price closes over the down close candles. These are the down close candles. These are going up. These are going down. And then how would you mark out your change in state of delivery? Right there. And then what does price do? Price is going to leave this area for now. And then when price pushes back, price is going to push back into that change in state of delivery. It's going to, but it probably will. It'll push back into that change in state of delivery. And then price will push higher. Like that. Obviously it won't be as smooth as like these closes and opens, but that's just an example. Down, up, close over that down close candle, and then price pushes back to that area, and then price pushes higher. I'm gonna delete that so you guys can see it right here on the 15-minute. Well, on the 5-minute, you can actually see it. It doesn't have to be a perfect line of down close candles. It can, but you just don't make sure it isn't like this. You know, like it isn't like this, and then change the state. Just it should be manipulation. That's what I'm saying. Like price should leave a range. Price shouldn't be trading within this range. Price should leave a range. See how it left this. I'm pretty sure this makes it a higher probability to change in state, but I don't know. I just use normal change in states, bro. But see, change in state gets tapped. What happens when change in state gets tapped? You can use a fixed stop loss, 5 points, and then target the high that just was before the move that came down. And then what do you see on the lower time frame? Oh, that was actually a really nice move, and price take profit very fast. Very nice. That is all I have for you guys today. I know there's mitigation blocks. Omar, if he knows what that is, he can make a video. But personally, not mitigation blocks. Yeah, mitigation blocks aren't something I've ever used. They are kind of just, yeah. I actually don't even know how to look for them. I just never use them. I never saw them important. You should learn them, but they're just kind of they're not in any of the models I use. So that's just one thing. I always grew up with when I started trading, I started trading with inverses. So I don't know mitigation blocks, but I can give you guys a link to mitigation blocks on TT trades. Well, T trades. Well, that's all I have for the PD raise video. There are, I think, possibly a few more, but that's all I'm going to tell you for now until I get a reminder that there's this PD ray, and then I'll make a quick video on it. But that's all I know, and that's all I use. Those are the PD rays I use, and see you guys later in another video.